Hello, everyone. Happy Friday. Welcome to the weekly Stock Talk. My name is Renad. So let's just go ahead and get started. Hi, Ben. How are you?
I'm doing great. How are you today?
I'm great. So, how did the week go?
Yeah, it was a mixed week. So we came into Monday on end of July, last day of July. So July actually had a pretty decent month, end of quarter, and so things were pretty rosy into the end of the month. And then we had Tuesday, Wednesday, Thursday, pretty rocky markets. A lot of data came out, and today seems like we finished on a mixed note here because TSX was up, but U.S. markets closed a bit down. So bit of an interesting week. Volumes were super light, with it seems like a lot of people on holidays.
Yeah. So, like you said, we had a couple of rough days and a pretty good month for July. So, was there anything that changed? Anything that you think, you know, to look at?
Yeah, so I think I've had a bunch of conversations with clients this week just about what's going on, and yields have moved up in the past, I'd say month and a half, and so kind of that question is something changing in the economic cycle that we should be doing, or is it more just kind of we're moving through this process where those tighter interest rates, higher interest rates, tighter financial conditions are just slowly eking their way into the system? And so I'd say generally nothing's materially changed. Obviously, we'll go through some of the slides and presentations. We can look at some of the data and information, but I'd say nothing's materially changed in the markets. And so as a result, I haven't made a lot of changes there. Some stocks are looking attractive, so I've been looking at some individual names, but from a big picture perspective, I still think you want to have some caution here.
Okay, and Amazon had some pretty good numbers last night, and their stock was reacting well. So, is there anything interesting there?
Yeah, so Amazon's a pretty good gauge for the economy, and so it's interesting to look at the numbers when they come out. Obviously, one of the biggest weightings in the indices in the Nasdaq and the S&P 500, so they play a major part for how the indices do. Um, I think with Amazon, it's worth watching, paying attention to, seeing where they're putting their future investment in. Spend a lot of money in AWS, which is like their cloud computing system, and that's paying off for them quite well right now. Um, I'd say from a downside, if you look at Amazon, they have super high turnover, so I think they can continue to do a better job there. But if you look at kind of the turnover and the employees, they only maintain something in the neighborhood of 30% of their staff annually. So they have lots of turnover. So there's opportunities for them to continue to do well. But yeah, their numbers were better than expected, and so I get this thought where the consumer is still spending, which is what Amazon said, but the debt levels are at all-time highs as well. So, we got a bit of a mismatch, but yeah, their numbers were quite good and their consumer continues to spend.
Speaking of employees, we have the Canadian and the US job numbers came out this morning. Was there anything
Mhm.
that kind of stood out for you there?
Yeah, so I'd say in both cases, they surprised a bit to the downside. So in May and June in the US, they had revisions. So you had, I think, a 49,000 job revision. So with economic data or employment data, it's always lagging anyways, but they always revise as well because they don't get the actual data until the next month. So two revisions lower in the US, so almost 50,000 jobs lower than expected. So I'd say kind of bad news-ish for the employment numbers, but good news-ish from the fact that this is what the central bank was looking for, is they wanted to see unemployment start to rise before they stop raising rates. So we'll look at that a little bit. And in Canada, we had, I think consensus was something in the neighborhood of 20,000 jobs added, and we actually had a $6,500 or 6,500 job loss. So unemployment ticked up again in Canada. So listen, again, I think these are the laggingest of indicators, as I've said, employment. And so we're starting to see it play out. How many multiple months in a row do they need those numbers to be that way before they stop raising rates? I think that's worth thinking about. And excuse me, a couple of the slides I'll point to, we can talk about what I think is the likelihood of how that's going to play out. But yeah, unemployment rising.
Well, let's go ahead and look at some charts. You can give us a better image.
All right, sounds good. Let me know if you can see it.
I see a blank white screen.
How about now?
Still a blank white screen. Yeah.
Okay. That's not ideal. How about now?
I see myself.
Well, that's not perfect. Let's try one more time here. And if not, I'll change it up.
There we go. Yeah, I can see it.
Good. Okay, perfect. Messing around trying to get it on the right screen before, so I think I probably messed up the sharing feature. Looks like we're good to go, so I'll jump into it. I mean, some of these slides I think I put into the dailies, and excuse me, as I find good slides, I think it's important to revisit them occasionally and look at them. But this is the economic data, and so as I said, I believe it was 2 weeks ago when I first kind of put that out, where I showed consensus for where the different investment houses thought GDP would be in Canada. And as I said at the time, Bank of Canada, I continue to believe, still thinks that we're going to have GDP growth 1.5%. Q2 came in at 1, certainly almost a full, a full half percentage point difference than what the Bank of Canada had. And we presently, National Bank, think that GDP growth will be close to 0. Pretty much all of the bank-owned brokerages in Canada as well think they're going to be running kind of somewhere between 0 and 1%. So Bank of Canada is extremely optimistic. So it plays a part in what the bank does here. And so GDP and inflation, these are the two metrics the bank look at. And so it looks like we continue to come in well below their expected GDP growth. And so this is a little bit on employment, and then the next slide will be on inflation. So try and touch a couple things on Canada, and then we'll touch a few on the US, because whatever happens in the United States has an impact in Canada as well. So let's take a quick look. This is today's updated data. So National Bank put out kind of an update on a few things, but unemployment, as I said, we're starting to see that unemployment rates start to tick up. And also we saw wage inflation continue to be a bit of an issue, where we saw wage inflation kind of at 5%, which is extremely high. I think probably this cycle high. As you see unemployment start to tick up, and likelihood as if unemployment starts to tick up, then wage pressure starts to come down as well. So continue to watch those two things. And then, which everybody I talk to wants to talk about immigration. So we continue to see this this population growth accelerating quite quickly. And housing continues to be something that's a bit confounding in Canada, where we had kind of the best annualized new housing starts, kind of an annualized 581,000 new housing starts. We certainly won't stay there, because when we look at this metric, we have construction employment falling off a cliff. And so at some point, we're going to probably revert closer to the mean, which is somewhere in the neighborhood of 250,000 homes a year, where we probably need 600,000 a year to keep up with the population. So a bit of a mix as to what's going to happen with housing, but ultimately I think this puts a floor under the prices, and interest rates is the other variable that we'll continue to watch. But I think ultimately comes down as the economy continues to slow over the next 12 months. So inflation, this was the other one. So as we look at inflation, so if we look at these numbers here, this gray band is what the Bank of Canada's target range is, where the blue one would be the inflation number. And so, inflation never stays in the same category for an extended period of time. We're always moving, always up or down, below or above. And as we start to come in now, we're looking like we're well within the Bank of Canada's range from a, we'll say, core inflation. They like to use core inflation, whether you like it or not, which excludes food, energy, mortgage costs. So that's a major input for most people. But core inflation is right within the range now, and growth slowing as well. So, I think it's important to pay attention to these. As for whether we're in a recession or not, certainly we can debate that and decide when and how that plays out. I think likelihood is we meander for a little while here. But this is a great chart from Manulife that shows kind of the different types of indicators: leading, coincidental, and lagging indicators. So if we look at these leading indicators, there's a yield curve, senior loan officer, ISM orders, 30-year mortgage, financial conditions. These are all kind of screaming higher risk, where the kind of the medium risk would be new home sales, investment grade corporate spreads. So those have stayed pretty tight, surprisingly. Initial jobless claims. So this was at the end of June. I think that number is probably going to be flashing a red here. And then, as I mentioned, kind of the last one that the central banks were waiting for was these jobs numbers. So this is job openings and unemployment. Still kind of, I'd say, green, but these are the lagging numbers, and they're starting to kick in and show that things continue to slow quite quickly. And so this was to my point from the conversation that you asked at the start, which is like, what's the jobs numbers look like? And so as we start to see this net jobs revision, kind of six net negatives in a row, the question begs, is that enough for the U.S. Central Bank FOMC to hold off on any further rate increases? I'd argue highly likely. Coming into June, there was, maybe a 10 basis point likelihood of more rate increases this year. I'd say these job revisions came out this morning, that's probably gone close to zero. And so we continue to watch the job numbers as a major part for what central bank does from here. So a little bit to your point about your question just about Amazon, what happened, how good numbers because the consumer's still spending. That's effectively what this looks like is, yes, the consumer continues to spend, but all that spending is coming from debt spending. And so you get consumer debt at pretty close to, well, I'd say all-time highs, even if you stretch this back a long time. This is 23 years of data. And then if you look at personal savings, again, personal savings have dropped below that $200. We haven't been below those levels in a long time. So I'd say the consumer stretch, this is US data, Canadian one looks quite similar, but continue to believe that that the consumer stretched and personal savings being used every month right now. So this is commercial banks, tight lending standards versus easier standards. So we started to peak, it looks like, and then we've started to accelerate again. So, we had a brief period where we had Silicon Valley Bank and some of the other banks go bankrupt and get into trouble. So we had a bit of a reprieve there as the government came in, effectively said we're going to backstop deposits. Financial conditions eased a little bit, deposits started to pick up. And then as we got into the latter part, or we're getting into the latter part of the summer, tightening lending standards are starting to pick up again. So we'll continue to watch this. Two more quick slides, leading economic indicators, which I've shown in the past. So this is the blue line. So LEI stands for leading economic indicators, heavily into the negative. GDP tends to follow those numbers. So we'll continue to watch how those indicators play out. This was my point about rates. So we already saw these rate increases in Canada and the US. So those have effectively gone to zero after the jobs numbers today. And the last piece would just be on yield. So lots of questions. What's the yield curve look like? And so this is where we were to start the month, which is kind of short rates higher than long rates. That continues to be the case. But what we saw this week is we saw this kind of range, the kind of the 9 to 30 year start to tick up. And that tends to be an early signal that the economic data is going to get perpetually worse from here. And so we saw this start to tick up, and so we'll continue to watch that quite closely from here. That's it for the slides this week.
Amazing. So we saw a lot of comments this week about the yields. So how did the market bonds do with that? And if you want to comment on if people want to actually own bonds or ETFs.
Great. Yeah. No, it's a good question. I've had that question quite often over the last multiple months. I think we've seen from a yield perspective, we've seen the kind of the US and the Canadian 10-year bond yields start to move back towards the kind of October, November lows of last year. And so, what we got on the other side of that is we had a couple of easy quarters where bond prices went up, yields went down, stocks went up in that backdrop. And so I think the question is, do we see that again? I think we probably see bonds rally here in the next few quarters, but we're retesting those levels from last year. So it's an important point. So if we do see a breakout in bond yields in Canada and the US, then maybe something's changed. My view is it hasn't. So I think we're at an inflection point for yields. And then ETFs versus the individual bonds, I'd say it's going to depend. And in some cases, depending on how much money you have invested, if you have a few $1,000,000 invested, then owning some of the individual bonds probably makes sense because you can get them at good prices and good yields. Right now, the bond market functions where it's not like it used to before 2008. Before 2008, the banks carried inventory. So, if we wanted to go buy bonds for our clients, we could go into the inventory, see what's there, buy the bonds, and then the clients only get kind of that one spread between our trading desk and what we give them. But right now, if I call the bond desk and say I want, Government of Canada bonds, the bond desk needs to go out and get that. And so the bond desk will go to CPP or the federal government or the OMERS and say, I want to buy some bonds. And so they end up having to, put in a level of pricing there, and then a level for us, and then clients get the final yield. So it might not be super effective if you don't have enough money going into those bonds. Where the ETFs are going to give me liquidity at all times. So, for example, if I want to have exposure to the Government of Canada bonds, I can buy XGB, which is the Government of Canada bond index that trades on the TSX. And so it's going to give me effectively the same kind of risk reward profile and a little bit better price discovery so I can understand what the value is worth. And so it's going to depend on how much money invested, and they function a little bit differently depending on what I'm looking to accomplish. But they're both good vehicles, and I've used them both. It's just lots of variables involved around whether it makes sense for everybody or not.
Okay. And I do want to mention that you mentioned stagflation a couple of times. So maybe we can remind everyone what that is and what assets do well in that kind of an environment.
Yeah, no, it's another good question. I think I get stuck up in the terminology sometimes. And stagflation is an environment where growth is decelerating, so GDP is going down, and inflation is going up, accelerating. And so we've been in and out of that environment for a long time. But historically, what does well in that backdrop is government bonds do well, gold does well, gold miners, US dollar tend to do well in that environment. And so with the view that that's where we are today and likely for a couple of quarters, I think you want to continue to maintain exposure into those assets, and that's what we've been trying to do.
Okay, amazing. Is there anything else you wanted to add?
I don't think there's too much. Obviously, it is a bit of a quieter time in the market right now, and we're getting into a period that's a little bit slower. So, markets can be a little bit more dislocated in this backdrop. So I'd be watching them quite closely. But we saw bonds rally pretty hard today, like a nice move in that market. So I'd be watching that and saying, where do we go? Does this continue? And I'd say that'd be the most where I'd be paying attention to for next week.
Okay, perfect. Well, I think that's it. Well, thank you for everyone that joined us for the weekly stock talk. Have a great long weekend.
Yes.
And we will talk next week.
Sounds good. Thanks. Have a good weekend.
Perfect.
All
Have a
right.
good one. Bye.
Take care. Bye.